So I say, forget the cookie cutter approach to investing. Your investment allocation should be designed for your life, for your goals, for your retirement, not some bureaucratic guidelines. And here's the thing, when your life adjusts, you adjust. If we haven't met before, I'm Planner Mike, a certified financial planner professional and owner of True Wealth Financial. I believe that your retirement should be prosperous, enjoyable, and purposeful. And a lot of people dream about retirement, but find the actual path or transition into it to be complex, confusing, and a little bit challenging. And it makes sense. It's all new. You've never done before. I help Christians create and optimize a retirement plan so that they can retire with confidence. Today, I want to continue discussing investing, specifically how to create an individual, personalized retirement investment asset allocation. One that's designed for you, one that's designed to support your goals, your life, and your retirement. In my opinion, this will help you greatly retire with confidence. So if you've been with me throughout the month here, we've been talking about investing. A couple weeks ago, when we started the month, we talked about the new risk that starts at retirement. That risk is called sequence of return. So in general, everybody has the risks of principal risk and inflation risk. But when you start taking money out at retirement, there's a new risk that manifests itself called the sequence of return risks that you didn't have when you were in accumulation, when you were saving money away. The answer to that is to create a 3-bucket approach, or what I refer to as the 3 jobs of your nest egg, what they need to do to help mitigate that risk. And we talked about what's included in those buckets and how to derive them. And today's show actually kind of dovetails off of that, in that I want to talk about the idea of creating an personalized, individualized asset allocation. So to help that, what I want to do here is I want to kind of give you the traditional approach towards investing, especially in retirement, what I see as the problems with it, why it's kind of ridiculous if you actually think about it, and then I want to give you the solution to include an example of this. So the traditional approach towards investing generally is a ratio of stocks and bonds. You might have heard something like an 80-20 or a 60-40, where the first number represents how much stocks you're going to have in your portfolio. And when I say stocks, just know that I don't mean individual stocks like Amazon or Apple, not individual stocks. In my opinion, they're too risky, but more like stock mutual funds or growth stock ETFs, things like that. And so that's there's a ratio between us. And generally, the guidelines is to take 100 and subtract your age from it. And that should determine how much you should have in stocks. And then the rest would be in bonds. So for an example, if you're a 20-year-old and you're investing this way, you would have an 80% stock portfolio and a 20% bond portfolio. If you're 50 years old, you'd have 50% of your portfolio in stocks and 50% in bonds. If you're a 65-year-old, you would have 35% in stocks and 65 in bonds, right? So you basically take 100 minus your age, and that determines how much you should have in stocks, and then the remainder of that would be in bonds. That is the traditional guideline, industry-wide approach towards investing. And I think there's some problems with that. The problems really are twofold. Number one, I believe that would make your overall portfolio too conservative. The whole point of investing is to get a future potential profitable return. That's the whole point. And even more so when you're in accumulation. When you're in accumulation, when you're saving for retirement, all you want it to do is grow. That's it. You just want it to grow. Well, bonds are designed for income. So why would a 20-year-old want bonds in their portfolio? Why would a 50-year-old who still has 10 to 15 years to retire, why would they have an instrument, an investment that's designed for income? That's why they call it fixed income investing. Okay? It doesn't make sense. What's going to happen is if you have bonds, you're not going to beat inflation over the long term. It's going to catch you from behind and tackle you, right? So generally speaking, that approach towards investing results in a portfolio that is too conservative, not growth oriented enough. The second consideration is that it doesn't take any other factors of your life into any kind of consideration. It doesn't account for how much income you need, doesn't account for how much your wealth you have, doesn't account for what your goals are, or what your debts are, or what your legacy plans are, or future windfalls that you might have from inheritances or businesses or properties or rents, whatever. Nope, just your age. That's all we need. We just need your age, and then I can design a perfect retirement portfolio for you based upon that. Doesn't that sound kind of ridiculous? I mean, imagine if we did that with other areas of life. If the medical industry says, okay, your ideal weight and the amount of food, the calories you consume should be derived based upon your age. So forget that you're 6'6" and athletic build, don't worry about that. Or don't worry that you're a 4'8" petite lady. Nope. We're going to take your age and we're going to tell you exactly how much you should eat based upon that. Or imagine if we did speed limits, right? We took speed limits. We say, okay, if you're 30, you can drive 60 miles an hour. But if you're 65, it's too risky, too much. Your speed limit is going to be 40. And we're just going to base that off of your age. Forget the road conditions, the hills, whatever. We're just going to take your age. Or how about square footage of your home? If you're 60 years old, 1,500, that's all you need. You shouldn't have a family anymore. They should be grown and gone. And so we're going to judge you based upon how much square footage you'd have simply on your age. And that's going to derive everything else. Don't worry about how many people you have living in your home. Don't worry about your commute. Don't worry about how much money you have. Nope. We're going to take one factor of your life, and that's going to drive how much square footage you have. Now, doesn't that sound ridiculous? The reason why it sounds ridiculous is because it's ridiculous. And yet with investing, we say, don't worry about anything else in your life. Just take 100 minus your age. That's it. That's how we judge your whole investing strategy. Pay no mind to anything else in your life. Don't worry about how much money you have. Don't worry about where your goals are. Don't worry about your health. Don't worry about your income needs. Don't worry about anything else. Where you live, the taxes, nothing else. Just take your age, and that will tell you how we should invest your money. That is stupid. And yet, that is the benchmark of most of the financial industry. And yet, with other areas of money, we don't do that. If you just take emergency fund, the standard guidance of an emergency fund is you should have 3 to 6 months of your expenses, which means everyone's expenses are different. And it's a range of 3. You could have 3 months, 4 months, 5 months, or 6 months. You could have a range. So that means how much of an emergency fund is based upon the unique circumstances of your life. But when it comes to investing, nope. 100 minus your age, that's how much stocks you should have. The rest should be bonds. I think that's ridiculous. So, okay, Mike, you proved my point. I'm sold. What's the answer? Well, I believe the answer should be an individual personalized asset allocation. Right? So what do I recommend? I don't recommend an 80-20. I don't recommend a 60-40. I recommend that you go through planning and that you have an asset allocation based upon your actual retirement plan, your goals, your income needs, etc. And I want to show you how to do that here in a minute. But if you're finding this information helpful and valuable, please hit the like button. It'll let me know to do more shows like this. Plus, it's a great way to say thank you. So how do we go about doing this? Well, like I said, this show kind of dovetails off of last week's, which is the idea that if you have a feasible, solid retirement plan, you can then begin to see in the future years when you either need or want income, meaning that you need income from your financial assets, right? So if you remember how we come up with creating your retirement income, we first start with your human capital, right? What are you getting from work or part-time work or consulting or whatever it might be, rents, things like that. And then we add to that your social capital, Social Security, pensions, et cetera, disability benefits, things like that. And then if you still need more income, that's when we take it from either personal use assets, property or cars, things like that you no longer need or want, or we take it from financial assets. And that income should drive your investment strategy, right? Now, when you're in accumulation, all you want is growth, right? It makes perfectly good sense in my mind to have a 100% stock or equity portfolio, right? Generally speaking, that's what I recommend for most of my clients because we want growth. But as you begin to transition towards retirement, your investments need to change. Ideally, 3 years out ahead of time, you need to begin shifting your investments accordingly. Once you start needing income, right? So once you have a plan, a feasible plan of record, and you know that you need income from it, then you want 1 year worth of cash and 2 years worth of bonds, right? Because you need income. Bonds are designed for income. That's the whole point. And the remainder of it, the remainder of your portfolio would be geared towards growth, right? The idea that you're 60 or 65, you still need money that outpaces inflation for when you're 80 and 85 and 90 years old. And so based upon that construct, everyone's asset allocation is going to be different. So as an example, we've been talking about the starter family. If we look at their feasible plan of record and we go to the retirement cash flows, they need $27,000 this year, $57,000 next year, and $27,000 in the third year, which means we'll have $27,000 in cash and $84,000 in bonds, and the rest of it is in stocks. So of their $730,000 that they have, that's going to be the breakdown. So when we look at an overall portfolio perspective, that means that they're going to essentially have 88% in stocks and 12% in bonds and cash. So they'll have not an 80-20 or a 90-10, they're going to have an 88-12. Now, if you go to anybody and you say, I have an 88-12 portfolio, they're going to look at you like it's kind of weird. Say, how'd you come up with that? But here's the thing. This is backed up by actually doing the work. There's some rationale to support this. People say, I'm invested in a 60-40. Why? Well, I took some test that asked me random questions and it spit out an answer that says I should have a 60-40. What is that? Or my advisor says I should take my age and minus that from 100 and that's how much stocks I should have. Now, that's silly. Now, so the starter family is 65 years old. Based upon their income needs in the future, they should have an 88-12, in my opinion. You say, Mike, that's too risky. Based upon what? Based upon what? If you are my clients, I'm going to drive you towards debt freedom, which means you don't have any debt, which means your mortgage is paid off. That reduces risk. If you're my clients, I'm going to drive you towards the idea of having a 3 to 6 months of emergencies in the bank, parked in cash, not growing, just there for rainy days. That reduces risk. We've gone through, identified your needs, wants, and wishes. You have a feasible plan of record, which means we've reduced risk inherently. Over time, we're going to stress test this with resilience strategies. But no. Forget all of that and just take your age and minus that from 100, and that tells you how much you should have. Well, I don't subscribe to that cookie cutter approach to investing. I think it's kind of ridiculous. So I say, forget the cookie cutter approach to investing. Your investment allocation should be designed for your life, for your goals, for your retirement, not some bureaucratic guidelines. And here's the thing. When your life adjusts, you adjust. That's the whole idea of life-centric retirement planning. We put your life first and it drives your money. The money doesn't drive your life. So in conclusion, today we talked about creating a personalized asset allocation. If you're still with me, find this information helpful or valuable, please consider subscribing. Next week, Lord willing, I plan on talking about asset location. Imagine the confidence you'll have as you transition into retirement, knowing that you have an asset allocation based upon a feasible plan of record. That's the benefit of retirement planning. That is the whole idea of this stuff, to help you retire with confidence so you can focus on your life, not focus on the money. Till next time, hope this helps you on your path to a prosperous, enjoyable, purposeful retirement. Hope you have a great day. Thanks again for taking the time to watch this week's episode of the True Wealth Financial Show. I encourage you to like, share, and subscribe so you don't miss any future episodes. Additionally, you can find more information on our website at www.truewealth.show. One final note, though, as we wrap up to today's show. While I hope the information was helpful, valuable, and insightful, it's really for information and educational purposes only. Prior to making any decisions or taking any actions, I'd strongly encourage you to talk to your legal, tax, estate, or financial advisor who's familiar with the unique circumstances of your particular personal situation. Thanks again for watching, and until next time, hope you have a great day.